Hi, this is Mark from A. Brown ESQ LLC, and welcome back to Tax Chronicles. Here, we like to look at the opinions that are issued by the U.S. Tax Court, and we like to break them down so that the average Joe can understand what these opinions are about, why the U.S. Tax Court determined the way that they determined, and what are the factors that they looked at in making their decision. This past week, there was a really interesting case that dealt with tax fraud that was issued. The opinion that was issued was for the case Myanmar versus Commissioner. Now, here in this case, the petitioner was a tech guy. He had a very lucrative, successful tech business. But this petitioner, through the help of his CPA and the help of tax advisors, used offshore entities to move a lot of that money offshore. The court described his activity as making a series of large transfers of money, creating a quote-unquote convoluted money trail. This definitely caused the IRS to raise their eyebrow. It also didn't help the petitioner's profile that he was spending a large amount of money on luxury items and flashy items, such as restoring an old car, and he was paying, him and his family were paying a country club fee for over $20,000. So just the activity alone that he was making in his purchases just added extra curiosity on the part of the IRS. So in this case, the IRS had to prove two things in front of the tax court, or better yet, I'll say the tax court was looking at two issues. Firstly, the IRS had to show the tax court for each tax year that was under review by the court that, number one, the taxpayer underpaid his tax. This was proven by the court, by the IRS. And number two, that the underpayment was attributable to fraud. So what was most interesting to me was what proves that someone's committing fraud. The IRS, the tax court wanted the IRS to prove a number of different factors. In this case, the tax court stated that fraudulent intent can be inferred from various kinds of circumstantial evidence. The tax court called these the badges of fraud. They said that these badges included but weren't limited to, number one, understating your income; number two, inadequate records; number three, failure to file your tax returns; number four, implausible or inconsistent explanations of behavior. I like that one. That's basically saying if we can't understand what you're doing, that's suspicious. We're just going to call it a badge of fraud. Number five, concealment of assets. Number six, failure to cooperate with tax authorities. Number seven, filing false documents. Number eight, failure to make estimated tax payments. Number nine, dealing in cash. That's one of my favorite factors. I mean, we all know that mom and pop bodega that only uses cash. I mean, and it might even be for legitimate reasons. Maybe they don't want to invest in a credit card processing machine. They might not want to pay credit card fees, right? But it's considered a potential badge of fraud if you're only dealing in cash in your small business. Number 10, engaging in illegal activity, and number 11, attempting to conceal illegal activity. The court said that not just one badge is necessarily dispositive. That means just being guilty of one of these 11 activities, that doesn't mean you're automatically guilty. But multiple badges put together, that could be strong circumstantial evidence of fraudulent intent. Check out the next video. We're going to see how the court determined, in consideration of these 11 badges of fraud, what the court decided when it came to this case. Check out the next video.